Welcome to our three-part series. I'm very excited to share these concepts with you. They can literally change your life. I know it's changed mine, and I've seen it change many others of people that I've been working with. So sit back, relax, and prepare to learn how to strategically grow your wealth. This is a three-part video series. The first one is going to be the problem. The second one is going to be the solution. And third, we're going to put it all together and show you a case study. Part one, we're going to talk about systems versus products and one of our foundations called the Core Four. Then we're going to talk about how the most common financial systems and products are failing you. Then we're talking about the eighth wonder of the world and why you are not earning it. And then finally, we are going to follow the money. I know in this world we live in, there is a lot of technology out there. I would encourage you to turn off your phone, close Facebook, maybe even close your door. This video will be less than 30 minutes, but I believe you it will, or believe me, it will be very valuable. Good time spent. If you haven't met me personally, my name's Anthony Faso. I'm the owner and founder of Infinite Wealth Consultants. I've been a CPA for almost 20 years. And during that time, I got exposed to a lot of different concepts, strategies, and products. And in 2008, I don't know about you, but I got punched in the gut when it came to financially. Not just in my pocketbook, but also seeing the pain with my clients. They did everything right. They followed what Wall Street and their typical financial planner told them to do, and they lost half. They lost the equity in their house. Many of them got fired, and unemployment was double digits, and they could not find a job. I don't know about you, but that scared the crap out of me. Not just for my clients, but also selfishly for me. I was like, I don't want that to happen to me, because I started doing my research, and you know what? That happens all the time. There's been many of crashes. There was a crash earlier in the decade in 2000. There was one in the 90s. I mean, they've constantly been happening, and so I realized that I need to do something different. I need to start looking and finding people that are doing something different, that are doing well during this time. And I noticed a few of my clients, not only did they not lose money, but they were actually in a position to make money. So I started following them and asking them and learning from them what they were doing. You know, it was very surprising, maybe not looking back, but not only were they doing things different, they were doing things the exact opposite most people were doing. So I spent some time and followed and started practicing their strategies and using those products for myself, and it worked. So then I started teaching some of my clients these same strategies, and it worked for them. So much so that eventually I stopped doing taxes, and now my focus of my practice is just teaching people these strategies that we're going to talk about in this webinar series. So let's get ready. Let's talk about systems versus products. Now, I'm sure you all know I've been to McDonald's. Now, let's say that over here that this is you. Let's say we have a contest. Who can make the best burger, McDonald's or you? Who do you think would win? I tell you, for me, I'm not even a cook, but I think I can make a better burger than McDonald's. Now, my wife will probably argue that because she knows I'm a terrible cook. But I bet most of you can make a better burger than McDonald's. Now, if the average person can make a better burger than McDonald's, how come they sold over 1 billion of them? It's not because they have a better burger, aka a better product. It's because they have a better system of delivering that burger. You're going to have that same quality of burger whether you go down the street to McDonald's, you go across the town to McDonald's, or anywhere in the world to McDonald's, you're going to get almost the exact same burger. they have an amazing process. So as far as a system goes, what ingredients do you need in your system? We call this the core four. Now there's a couple things we want to increase and a couple things we want to decrease. The first thing we want to increase is control. And most people are surprised that we start here. And that's because most people, their financial plan is based on hope. They hope their financial planner is doing what's right. They hope their money is going to earn more money. They hope fees aren't going to be too bad. They hope taxes are not going to be too bad. But we don't want to base our financial strategy on hope. We want to empower you to be in control. The next item we want to increase is your return. Now please notice I didn't say rates of return, because I have yet to meet somebody who can pay their mortgage or can put food on the table by rates of return. We need cash money. We need to focus on not the rate that that's earning, but at the end of the day, how much money are we going to have? Next, we want to talk about risk. You know, these two actually go hand in hand. Because if you've ever been to a typical financial planner, they may have you fill out a risk analysis. And they might tell you, well, the more you're willing to risk, the bigger reward that you may get. I don't know about you, but I have a very low risk tolerance. I do not like losing money. I've done it before and it sucks. So when I look for an investment, and I've learned and found some investments that are alternatives to Wall Street, where you do not have to take on a huge risk to get a huge return. Now, if you've heard of Warren Buffett, he has two rules of investing. The first one is don't lose money. The second one is refer to Rule 1. So we want to start looking for using strategies and products that we are not going to lose money. Now, the next pillar is taxes. We want to get taxes as low as possible. Many people don't even realize it, but taxes is one, or if not the largest single expense that they have. And unfortunately, most people are taught to defer that, and they pay that in retirement. The problem is they're paying that in retirement when they have the least amount of money to pay for that. You know, there's a common misconception that you're going to be in a lower tax bracket when you retire. I know that that's what I thought, and I got in for a rude awakening when I had my tax practice and saw people, their taxes actually went up. Now, how could that be? I'll give you two quick little things. One is, what is your biggest tax deduction? It's probably kids and your mortgage. Now, when you're in retirement, I'm hoping that your kids are still not dependent on you, but even if they are, the IRS is not going to let you take a deduction. Now, what's your plan for your mortgage? It's probably to have your house paid off or almost paid off. So your two biggest tax deductions are gone. And then following typical financial planning advice, your IRA income is taxable, 401k is taxable, Social Security is taxable. If you have an investment account, it's taxable. If maybe you're working a part-time job, that's taxable. So many people will not be in a higher tax bracket when they retire. So we want to start looking at products and strategies that are going to lower our overall tax bill, not just focus on what that tax bill is today. Now let's talk about where people store their money. Once they get their income, they pay their expenses, and they typically place their money in one of two spots. Now, if it's a short-term need, they're typically going to put it in a bank because they need to use it soon. They do that because the bank is liquid and safe. But the downside is they are giving up growth. The money does barely even grow. In fact, it's actually decreasing or shrinking when you take into account inflation. Now, the next place people store money is for more long-term. Typically, they use an IRA or 401k. And that's going to be used for retirement. Now, they do that because they're hoping for growth. Again, the word hope. But what are they giving up? Safety and liquidity. What you're going to see here is for short term and long term, you're kind of giving up some things to get some things. Now you can see we have a third box here. And this third box we're going to address in our next webinar. So now let's talk about compound interest. Now, compound interest is the eighth wonder of the world. Albert Einstein is credited as saying, "He who understands it earns it, and he who doesn't pays it." So let's take a closer look at compound interest. This here is called the compound interest curve. And you're going to see at the beginning, it's a little slow, maybe a little boring. And at some point you hit that sweet spot and it starts to take off. However, I will tell you, there is a lot of wealth to be made in being boring. Now, Peter Lynch wrote a book, and it was called One Up on Wall Street. And what he said, that in the 1600s, Peter Minuit bought the island of Manhattan from the Manhattan Indians for $24. And in his book, Peter said if he could have stored that and earned compound interest from the 1600s until now, earning 8%, he would have $30 trillion. That would be enough to buy the entire Manhattan Island with all the buildings on it and all of the diamonds of Tiffany's and all of the professional sports teams, including the Pittsburgh Steelers. Now that shows the power of compound interest. Now let's take a more realistic approach. Let's say you put $100,000 and it was earning 5%. Now that first 10 years, you're going to earn $62,000. But the next 10 years, do you see how you earn even more? And then you earn even more. Each year, your earnings goes up. And what's interesting, in the last section of the 10 years, you earn $422,000. That's almost half of the total amount made, all done in that last 10 years. That's what we call that sweet spot. So let's take a closer look. Well, before we do that, Warren Buffett had said, "My wealth has come from a combination of living in America and compound interest. The big sums start accruing toward the end." So if that's such a big deal and everybody knows compound interest is the eighth wonder of the world, well, how come people don't earn it? Well, let's take a look. Really two things. For one, people spend it, and two, you lose it. So if we take a look, like here is a compound interest curve, and then before we dive into that, let's take a look at some numbers. Okay, so let's go out 50 years. Let's say we could put our money that would continually compound at 4%. And we start with $100,000. Okay, a couple things to point out here. That first year, you earn 4%, $4,000. But that second year, that $4,000 is continuing to compound, so your earnings has gone up. What's important to note is each year, your earnings go up and up and up. Towards at that last year, you're earning almost 7 times as much as you were in year one. That's the power of compounding. Now, if you notice, what is the total amount that we could earn? That's $710,000. Okay, so let's say something happens in year 5 where you have to spend $50,000. We just broke the compound interest curve. As you can see, your earnings were almost cut in half. It doesn't take until about another 10 more years before it just equals where it was before. Now, by taking out just $50,000, we went from 710 to 407. But now let's say in year 10, you take an investment loss. Ouch. Oops. Now we haven't even recovered from the first time that you spent money. So now our interest is even less. And now the total amount that we could make, best case, is $157,000. Now let's graph this out. So right here, our money was compounding, and then in year 5, we took the money out that we spent it. And then in the year 10, we had an investment loss. So we broke the compound interest curve twice, and it had to restart. So instead of having $710,000, you only have $157,000. Now that difference here is $553,000. Now, we only took out $100,000, and it cost us 5 times that amount of money. Now, that is called opportunity cost, meaning because we lost the opportunity to make that $553,000. But don't worry too much, because in our second video, we're going to show a strategy where you can take advantage of that lost opportunity cost in all of your financial decisions. Now, the first problem here is money that fails to compound fails to make you financially independent. Next, we are going to follow one of the best systems for making money. And this is going to be banks. They've been making money from hundreds of years. So let's see if we can learn something from the systems that they use with money. Banks have 3 rules. They need cash flow, which is your money coming in, whether that's a deposit or a payment. Also, once that money comes in, they're going to leverage that out and put it to work. That's going to create velocity because their money is constantly working. Money does not just sit inside a bank. Let's say that you put $10,000 in the bank because it's safe and it's liquid. We're going to be conservative and say the bank's going to pay you 1%. They are not right now, okay? When you put that money in the bank, what is the bank going to do with that money? Are they going to seal it up in an envelope and put it in the vault? Say, hey, you know what? Do not touch this money until Tommy or Susie comes back. This money's her. No. The important thing is for a bank, that 10 grand is a liability to them because they owe you 10 grand plus interest. So what is a bank going to do? They're going to use leverage and velocity. What they're going to do is they're going to take your $10,000. They're going to loan it to somebody to buy a house, or maybe somebody to buy a car, and somebody to pay off credit cards. Let's just say that the average of all of those rates were 10%. Now let me ask you, how much more is a bank making than you? You're probably thinking 9%. But again, you're going to continue to hear me say, we do the math. So let's take a look. It costs a bank $100, which is your 1% on the 10,000. However, they earned $1,000, right? So their return is not 9%, it's not 90%, it's 900%. Do you see the power of having a system to use your banks? And do you see why banks make so much money and they typically have one of the nicest buildings in town? So what we're going to show you in one of the other videos is how you can leverage your savings to act just like a bank. Now, one thing that's very interesting is that no matter what happens when you buy something, money always flows to the bank. Now, let's say that I'm going to use an example of a car. I use that just because it's very easy to relate to, but it doesn't need to be a car. Maybe you are not a car person, but maybe you like to go on vacations. Or maybe you have a business that you're continually having to buy equipment for. Or maybe you're trying to create passive income and you are putting money and buying real estate. Whatever the purchase is, it doesn't matter. Okay, there's an infinite ways to use this, which is why one of the reasons why we called our firm the Infinite Wealth. Now, the downside of paying in cash, well, we spent the money, so we lost the opportunity for us to put that to work. Now, if we chart this out, in order for you to buy that car or whatever your or is, you need to save money. And where are most people going to save money to buy that car? In the bank. Now, when you save up enough money for the car and then you buy it, what happens? You spend the money and your account goes down to zero. But you do have the car, and you may be thinking, well, hey, I don't have a car payment. But how are you going to buy car number 2? You need to start saving in some sort of systematic manner. And when you get enough money to buy car number 2, you drain your account again. And then we continue this process over and over and over. Now, the other way to buy a car would be a debt. The advantage of that is you don't have to pay for it. You can leverage your credit. The downside is the cost, which is the interest. Because remember, if you're borrowing money from a bank, what you're doing is you're actually borrowing somebody else's savings. So you're going to have to pay them for the privilege for that. But let's say you buy your car with a loan. You take a loan and then you pay. You have to pay it back. And then what happens after you pay the car off? Don't most people go and buy car number 2? Then they get into debt and pay themselves back. And then they continue that process over and over. What I thought is very interesting when I looked at this is that no matter what, people are in the same situation. And also, where does the money flow? The money always flows to a bank, whether you're saving it or you're making a loan repayment. The bank is taking your money and leveraging that and creating velocity. Now, as part of the second video, we're going to talk about a third way to buy the car where you're not going to have to deal with this mess. So what this does, this creates problem 2. Money that flows away from you fails to make you financially independent. So in summary, there's 2 problems with the systems and products that most people are using to grow wealth. Problem 1 is money that fails to compound fails to make you financially independent. And money that flows away from you also fails to make you financially independent. Now, in summary of this webinar, we talked about systems versus products and our core 4. We talked at how the most common financial systems and products are failing you. The only people that are getting rich from that are the institutions that are selling you those products, aka Wall Street and banks. We also talked about the 8th wonder of the world and why you do not earn it. And then we talked about follow the money. And no matter where the money goes or how it's flowing, it's somehow flowing through a bank. That is about the end of our first webinar, but I had mentioned this is the first of a 3-part series. The next series, we're going to talk about the 2 essential principles of financial independence. And then we're going to talk about a different product for a different strategy. We're not going to just talk about, well, this is a better product that they're using and this is just a better way to do this. This is going to be totally different. It'll be very exciting to share that with you. We're also going to talk about the value of continuous compounding. You saw here how the compound interest curve keeps on being broken whether you spend it or you lose it. We're going to show you strategies and products to use where you will never break that compound interest curve. And finally, and probably one of the most important pieces of our next webinar will be with great power becomes great responsibility. And don't forget, we also have a third one. And that third one is going to put it all together and it'll be a case study. So I look forward to seeing you in our next webinar.